So, so let's start and have fun. We have a Sri Lihan all in there, and how nice. Um, okay, let me try to share so that, okay, so this is what we're going to talk about. Smaller, okay. Uh-huh. Yes, you can. You can do any. Oh. No, this is not for kitchen. This is for. This is the business plan is what I'm going to talk about today. Yeah, it's a different project. So you have a project that souvenir in the kitchen. That's for the first half of the semester, and after midterm is two different project that we're going to report only verbally. Yeah. So let's talk about that later because now I'm actually recording for the class. Yeah, I'll talk about that later with you individually. So so let's talk about the part of the business formation, that type of a business that you can run. We don't need to know all of the business, different types and different variations, because I think what you actually would remember is something that's logical, that's making sense. What type of a business that I want you to sort of know three different type of business in the future that you can consider about running. The easiest one is because of business, the type of a business is almost like a type of a vehicle. You have a sedan, you have a SUV, you have a fancy SUV, you have a racing cars. They all kind of, they can all run, but they run differently, and some are very sophisticated. So business, the type of business is the same. There's a very easy type of business. Two friends get together, somehow file with the government, and then become a partnership, and then you can start your business. You probably need to rent an office. Unless it's a home business, you need the office, but otherwise you can run a business very easily. And probably the tax is very easy, but the trouble is, because let's say this is the easiest one, is called the partnership. So the trouble is, in case something happened to that one partner, you lost your business, you have to re-register because people do die, and all of that. If me and Manahil, two of us, if one of us, something happened, or I don't want to be in the partnership anymore, then you need to re-register because your whole company basically is no longer making sense. And then if we wanted the company to be a little bit more sophisticated, and especially we want to protect our own money, because if you just form a partnership, you could lose money if your business lose money, because people can come and, chase after your own money. After let's say you bankrupt, you lost your business, you actually would have to pay them if you have money in your own bank. So that's not what we want. We wanted to separate ourselves with our business. If that's the case, because if your business fail, your villa is still your villa. People cannot, the creditor, basically, the bank or someone who you borrow the money with, they cannot come and chase after your own money. So if that's the case, you want to set up something called limited liability. So that means limited. You limit the liability only to the business, not your own assets. So if that's the case, if you lost the money, you borrowed the 2 million from the bank, and then you put into the business, and business didn't make any money, so you lost all 2 million. But of course, you have a car and you have a villa, you have all of that. The bank will not be able to say, you have to sell your house to pay me back, because you and your business is separate. So your limit, so that's why it's called the limited liability. It means your own, it's not a total liability. Liability is like You know what liability is, yeah? I'm liable for this. So it's only limited the liability for that business. So it's not unlimited so that you and your business is together, basically. So it's a separate. So once you separate yourself with your business, you're much safer with your own personal assets. And that's very common form in business practice. Most of the business are limited liability companies. So we call it LLC. And sometimes it's called WLL, which means with limited liability. They're pretty much the same. So that's a good company form that you can choose. The last one that I want you to know and is corporation. And in Qatar, I noticed it's called the shareholding company or something. It's called different names, but basically means it's a very sophisticated company structure. And when you form the company, you have to file as a corporation, the taxes, corporate tax. You would have a accountant working for you. You have an auditor checking on your transactions. So it become a very sophisticated, so if you're just running a very simple interior design company, you probably don't want a corporation because you're just adding more trouble for yourself with not much benefit from it. You'll be fine with limited liability. And also corporation is the best vehicle that eventually the company go public. Let's say Urdu, a big company, Kakurama, So if you want to list it on the stock exchange, you better start it with as a corporation, because limited liability company can be listed as a public company. The difference between public listed on the stock exchange, basically everybody can own a little bit of the company. Like I bought for a while, but now I sold because me and my husband found that's a good way to invest because we have a lot of confidence after the blockade. And what happened is the stock really came down a lot. But by then we said, Qatar is going to survive this, no problem. So we bought some stocks, but now we sold, and I think the problem is, because if in the future, and all of you should consider, you're not putting your money, under your bed. You have to invest here and there, and this class probably will give you some ideas, like where do you put your money if you have extra. So we bought some shares, and that was very good. It's a shipping company. It's called the Nakilat in Qatar. Probably you all know, shipping gas to all over the world. Anyway, so if some company goes to public, they should start as a corporation or shareholding company. But corporation doesn't have to be always public. You can also hold a corporation as a private, like you hold the shares within families or friends or people you know. It doesn't have to be on the stock exchange. So that's 3 different type of a company that we are interested with. And you should sort of know the difference of them if you wanted. Just a typical company, you will set up a limited liability. Or if you want to be very easy, as an interior design company, you can also be a partnership. But on the other hand, you don't want to risk yourself because interior designers can be sued. Yeah, once you sued, you lost a lot of money, and then you don't want also to lose your villa, basically. You want to separate yourself from your company. If you lost the money for the company, it's only for the company. It's not your villa, it's not your car, it's not your bank account. Yeah. Okay, so that's a very easy thing. And basically, all of these slides is shared with all of you. So if anything that in the future you want to learn a little bit more, you can go back and learn all of those. What's the minimum capital that need to set up a limited liability company in Qatar? If you're interested, there's all of these slides. Go through all of them yourself. And this class is not to help you to set up a company, because on the other hand, it's easy to set up a company. It's more difficult to make money. So we know that. So we can. So now we move on to to talk about the business plan. This is a part of your homework, basically, and you should all try to work, to do a business plan. And it's based on little home business that you can run from your home. That's the idea. Reality doesn't have to be really a reality, but it can be a reality. That's what I mean. Doesn't have to be a real business starting this semester, but it can be a reality that's starting from your home, a small company selling cupcakes or selling little things, doing business online through Instagram. So by the end of this, report to me only verbally. Tell me the money story about how much you want to invest, how do you want to spend the money, how you can make money, how do you want to sell it. Give me a story and with a correct number, basically. And just talk to me by the end of the semester. I don't need you to draw or illustrate. You can bring some kind of a bullet points or something that help you to explain to me, but I will not collect a project like what you see from the past. So I would talk about more what is included. You can talk about a lot of things. You can talk about how you're going to market your product, or but what I'm more interested is the money matter. The money matter actually is making sense. Basically, I need 5,000 real. This is how I'm going to spend. I would buy something and stock in my storage. I'm trying to sell it through Instagram. The purchasing price for whatever that I'm buying is such and such. So basically tell me the money story. So let me start to explain to you the money story of starting from accounting. You don't all need to know, because once you see the project, which I'm going to show you once I'm done with this lecture, that you know that a little bit of accounting knowledge is needed. So what is accounting? There are two types of accounting: accrual and cash. Yeah, two different types of accounting. But mostly in today's business is accrual accounting, is not cash accounting. So the difference is cash accounting is we do business, everything is in cash. You owe me, you will bring cash to me, and maybe sometimes check, but basically in the format of cash. Means once we done the business, you will also give me the money, or I give you the product, all done instantly with cash. Of course, today's world, we don't do that type of business, right? You will buy something, you may not right away pay. You might pay when the product is delivered, or if you have a very good reputation, you can buy with credit, which means I'm an interior designer. I worked with a furniture shop for 10 years. I'm going to buy a very fancy piece of furniture. You do not pay right away. You buy with your credit. You're reputable, you're trustworthy. You said, I'm going to bring the furniture and sell it, give it to my client. Once my client paid me, I will pay you back. So you buy with your credit. You don't right away, I'll exchange cash, So if that's the case, then you have to use accrual accounting, because not all the accounting or the changing of money is instant by the time the transaction is done. Or also it's possible, let's say you say, I'm going to design your villa, but you need to give me some deposit. So the fee is 100,000 to design fee, but the client will give you 50,000 as deposit, right? So you would receive the deposit, but you need to realize you haven't done anything for them yet. Yeah, you receive the money, but you haven't done anything. So that money in your account becomes your liability. You need to do work so that you're worth of that, right? So if that's the case, then the money comes in, but doesn't mean the money is already yours. You have to work to earn that money in the future. So if that's the case, you need to understand, whatever the money is in the bank, it's not necessarily your money. So that's why it's called accrual, is like step by step money in and out, but it's not synchronized with the business. It's a kind of a, happens at the convenience of a accountant, or that's just how we do business. So accrual accounting. Do you all get the idea of cash and accrual? And basically, I'll tell you the truth, nobody is doing cash anyway. Yeah, so forget about the cash accounting because no one is using that. It's not practical. Yeah, as I explained. So now, if you understand a little bit about accounting, you also eventually, if you propose any business plan to anybody, you probably need to do something called financial statements. So so you need to convince people the money comes in is for this purpose, the money from the bank is for this purpose. I'm going to spend this way. I'm going to make money, in whatever manner and whatever fashion. In that case, you need to propose together with financial statements so people trust. Yes, that number looks quite reasonable. You will make 50,000 real per year. That's not a lot of money, but let's say that's your business plan, and then you want to take a little loan from the bank say, that looks reasonable, I will give you this money. Or you ask money from your parents say, okay, yeah, that sounds reasonable, I give you the money, I trust you can make some money. So you need to put together something called financial statements together with your business plan. The business plan is a story, but the financial statement are the number story. Yeah, the story about those numbers. Yeah, so what are those financial statements? Income statement, balance sheet, and the statement of cash flow. So I started with the cash flow. We don't really do cash flow because cash flow is very complicated. And a lot of companies go bankrupt because they have a cash flow problem. They can make money, they have a good structure of making money, but sometimes, let's say I'm a manufacturer in China, I have this order from United States, then I put together and I start to manufacture. Suddenly the financial situation changed, or the policy changed, or the tariff changed between US and China. So the US a buyer suddenly withdraw the order and saying, I'm going to lose my deposit, which is whatever 20%. I can't take the order, buy from you anymore. If that's the case, because the factory already bought all the machine and all of that, they were ready to make products, and then they suddenly run out of cash. They have a good business idea, they can make money, but suddenly they're short of cash. Then they can no longer survive. Sometimes they bankrupt simply because they don't have enough cash. And I think we can all understand, but that's more complicated situation for business than the two other statements. So we will not touch on the cash flow. We'll just talk about income statement and balance sheet. Yeah, we'll just talk about this too. We don't talk about the cash because cash is really much more sophisticated concept. You need to do a lot of numbers to understand how much cash, is going to be in the account, which is different than whether the business is making money or not. By the way, whether the business is making money or not is we were going to read the income statement. That will tell you whether the business will make money or not. Because the income statement goes with the profit, whether some business will eventually make a profit. That's where you read the income statement. Yeah, income, right? Income. So profit, income statement. Balance sheet is talking about assets and liability and what is it? Assets, liability, and let me check. Okay, equity. Yeah. So that's what a balance sheet is all about. How do we differentiate? So let me ask, what's the purpose of income statement? I just explained to all of you. Right, income statement profit. That's, you know, if we want to know profit, we look at the income statement. By the end of the year, you will have an income statement for the whole year. Let's say I started January 1st. By the end of the year, December 31st, I'm going to look at my income statement for the whole year to see whether I made money or not. Yeah. So balance sheet, on the other hand, which is right here, this formula right here. Yeah, it's your balance sheet, basically. There are other things you need to know about balance sheet, but this is the basic. It's kind of like a household. It's easy to understand if we try to understand the money based on our house. For example, assets. What's our assets? My assets. My jacket is my assets. Is not very valuable. My car is my assets. Yeah, whatever I own is my assets. It's the same for the company. The company can own a building, can own a car, can own a lot of intellectual property also. You know, not only the tangible, but intangible can be quite a bit assets, you know, like a company like Apple, they have a lot of a patent. You know, they have a lot of intellectual property. That's very valuable. You're buying a company, you're not just buying, they own a building, they own a car, they actually have a lot of intellectual property. That's a big part of the assets. Yeah. For me, it's not my household. I rent a villa, so I don't really own a property. I own a car, I have something in my wardrobe, but is that really Li Han? I think maybe here is more important, you know. So, and that's true for all of us. The intellectual property is actually a bigger part of your assets than the tangible things a lot of times. Especially, for example, pharmaceutical company, right? They produce medicine, you know, to cure disease. What they actually own is not necessarily the production line, is the patent that they have on those. There's a lot of research going into to develop new drugs. So that's where the money is, the intellectual part of the intangible assets. So that's assets. You understand the household, you understand the company owns something, yeah? Basically, everything the company owns are the assets, but the assets has two different parts. Is equity and the liability, because a company can borrow money. Let's say I started money, I don't have any one single cent, you know. All of the money I started my company with is borrowed from the bank. So that means your assets equals to the liability you have. You haven't had any of your own money in the business. So you just borrowed, you borrowed the 2 million, you started the company, and then basically by that time you have assets of 2 million, and you also have the liability as a 2 million because you need to pay back the bank. But another way that you may have a liability and equity, which is, let's say I start a company, I have 1 million myself, my own money. I borrowed another 1 million from the bank. In that case, you started the company as a 1 million is called the equity. Equity is something that the owner, often is the owner owns the money. That's the equity. Yeah, in the business, the owner owns the money. It's your own money. Yeah, that's your equity. Yeah, equity can be in different formats. It can be in stocks and stuff. You know, that's your equity. That's your own money, and then and then you also borrow from the bank. That's your liability. You can also borrow from your parents. That's also your liability. You can also borrow from your friends. So basically, the money, all of the money is separated into two pockets. One pocket is your own money. One pocket is the money that you got from somewhere else, basically. So the money from somewhere else is liability because you need to pay them back. The money from yourself is equity. So those two portions together combined is your all assets, yeah? So let's say, let me ask you a question. I started the company. I borrowed $500,000 from the bank. I have 1 million from myself. Altogether, how much is the asset? Correct, yeah. $500,000 from the bank, 1 million from myself. Altogether, 1.5 million, that's altogether assets, yeah? And how much is your liability? 500,000 is your liability. Yes. Yeah. That's the beginning of the business. Yeah. After a whole year, let's say after I ran the business whole year, I made 500,000. I returned the 500,000 to the bank. Let's not worry about the interest. By then, do you still have any liability or not?
It depends if no, basically the liability is a loan.
Yes.
So if they say like, we'll give you $1 million, but we need 1.5 million in return, like there's a tax after a year, like it comes with interest basically.
Yeah.
So it depends whether or not.
Yeah. Let's say if we don't think about the interest, we returned all the money we owned, then we don't have a liability because we returned. Okay, so that's basically it. Just have some rough idea, you know. So that's why sometimes when you look at the company, you don't just look at the assets. You know, some company have a lot of assets, but they also have a lot of debt. You know, they own a lot of money from bank. They own their, you know, so that's not a very good, you know, in a way. If you have a lot of debt, that's not very good for a company, very heavily in debt, right? So many companies are in that way, actually. So it's not they own, you can see they own fancy buildings, they have aircrafts, they have a lot of stuff, but most of the money is borrowed from bank. So in the future, if you are thinking about investing, you know, you're not only looking at how much the company owns, you're also looking at how profitable the company is. Yeah. Okay, so I skipped something and look at the, actually I'm going to skip this one also because this one is a little bit technical. It's about how do we do accounting and how do we put together a statement. So I'm going to skip that. Actually, if we skip that, we probably skip the most of it, yeah? So, okay, let me show you. Okay, I'm going to show you this. I'm going to show a different thing here, which is your homework. Where is it? Wait. Let me see. I'm going to show you this document that part of the screen. I probably do this. Oh. Okay, so this is something that after today you can start to think about it. Move myself out of it. So this is also in the Google Drive, by the way. This is a story about a business plan. You can sort of read because there are always argument why you do certain business. Yeah. Even as a small business at home, there always has to be a reason. So if you can clearly say, why is it? You know, why you think that, that's a good, you know, it's not only to benefit you, but to benefit the whole society, you know, because only if you do that, you can make money. You know, making money is, you know, fundamentally is benefiting you, but also need to benefit the society. You know, other people will receive whatever service from you and it's meaningful for them. So here is this packaging business that, because the idea is, especially that's after the blockade, you know, there are a lot of things that used to be very easy coming to Qatar become a little more complicated. And what I was thinking, you know, just as an idea is when you bring some goods, some goods are very bulky. They're almost only airs, you know, like the potato chips. You're only bringing airs, you know. If that's the case, maybe it's better that you package those goods. You bring them in a big bulk, and then you produce and you package them so that you're not shipping airs from Kuwait to Qatar or UK to Qatar, you know. So that's why the idea is about the packaging company, so that you can package locally, that you will save some transportation, you know. By the way, when you ship something, you pay for the volume most of the time. You're not paying for the weight. So if you bring in something very light, but occupies a lot of place, it's actually quite expensive for shipping. So that's the idea. So that's the company. And the balance sheet, basically, this is something you're going to put together for the homework. And what you needed to do is you needed to say, what's my assets? Yeah, you say, that's 5,000 riyals, I will start a company. And the cash, this is, by the way, by end of the, by the time you start your company, by the time you start a company, before a lot of, wait, let me think about it. I think in theory, you need to do 2 of them, but okay, change my mind, sorry. By end of the operation, okay, by the end of the operation, let's say 1 year, okay, it just, we make a decision because we need to see we need to see how the business is operated, yeah. So by the end of the year, how much is still in the cash? Because you have to operate the company in order to get here anyway. You would not have any account receivable if you started the company the first day. I'll tell you what is account, but by the way, does anybody know what is account receivable? No. Account receivable, yes? Not really, yeah. But it's a good guess, yeah, very good guess. The account receivable is you already done some service to certain company, or you already sold the products, but you haven't received the money the time you sold the products, yeah? I sold you a chair. The chair I already delivered to your household. You're going to pay me later, yeah. I sent you the invoice. You're going to pay me later. I haven't seen your cash yet, but if I'm the accountant for my own company, I would say that the whatever the money for the chair is in the account receivable, because in the future I will receive the money from you. You will pay me in the future. Yeah, so whatever that the money you will receive in the future is in the account receivable. Yeah, receivable. Basically is the client who hasn't paid. Yeah. So the service, the product is already delivered, but the money you haven't received. That's in the account receivable. So if I send you an invoice, I would at the same time record the money in the account receivable to just say in the future I will receive the money. But of course, business, there's cheating going on, there's a lot of things. So every real in the account receivable in the future, you may not always receive. Some people don't pay. So anyway, that's account receivable. Yeah. Okay. So on the other hand, you will read something called account payable also. Anyway, that's account receivable. That's your assets, by the way. That's the money. It is already yours, but it's just not in the account yet. So that's why it's part of the assets. Part of the assets. So your assets, in this case, you can read the assets will have cash. Your cash is certainly your assets. Your account receivable is also your assets. Yeah, asset. Inventory is your asset, yeah? I bought a lot of chairs. I bought 100 chairs to sell. That 100 chairs are your assets, yeah? You own them, basically. It's almost like you own a building, yeah? It's your assets. It's something you owned, you know? So like same thing, like a household, a company owns the inventory. You don't want your inventory to be very big, by the way. That's quite burdensome to have. Like my inventory, I have tons of magnets to sell. That's all my inventory. I'd rather get rid of the inventory and then to convert them into cash or account receivable. Do you have a question? No? Okay, yeah. So you know that's your assets though, yeah? Prepaid expenses is also your assets. That's an interesting concept to think about it. Let's say I paid some utility, but I haven't even used, which is rare, but you probably would pay some kind of insurance to, let's say my building is insured for 10 years from fire, you know, that's actually your assets. Insurance is your assets. You paid, but you haven't received all of your service yet. Yeah, you will receive in the future. That's your assets. That prepaid expenses, you know, could have a lot of other expenses. Or for example, you paid, let's say you run a company, you rent a printer, you don't buy a printer because a lot of printers or plotters are very expensive, you know, for a design company. Sometimes you rent the plotter for 10 years. You paid for all of the money that you can use for 10 years. That is your asset. Yeah, that is actually your asset. You owns that. You owns that service. Yeah, it's your asset. Everything you owned, everything the company owned is your asset, yeah? But all of this is called the current assets. How about we do this? Are we, we're 10, okay, let's continue. We'll finish this. We'll finish very quickly with a rough idea. And I need all of you to come to me and ask questions. The one in class today and the one not in class, because, you know, you probably will get confused every so often, you know. The current assets, and the assets also have a current and the fixed assets. The current is like water, comes and go very easy. You know, cash is current. Current is basically based on the, you know, it's like water, you know, in English, current is also water, yeah? Well, something liquid, something goes, you know, easily back and forth, yeah? So cash, of course, you know, cash, or something you could understand that the current means something can exchange hands very easily. You know, if I give cash to you, very easily become your cash. So it's a liquid that can be changed very easily between people. Yeah, so the reason we want to say something is current and something is fixed, because current, you can quickly, let's say you need to pay the bank. Whatever that you own in the current, you can quickly get rid of, sell them, and then you can pay back to the bank because then it's current. But let's say you own building, that's not current. You cannot right away sell the building quickly, you know. You might get very lucky, but in theory, we do not consider that to be your current asset. You can own a building, that's not your current asset. And then that's a different type of asset. It's called the fixed assets. Yeah, basically it's kind of fixed with you for a long time. You cannot really I'm speaking too much English. You cannot easily get rid of them or convert them to cash, then become quite fixed with you. Yeah. So which means building, machine, you bought a machine to produce something, you cannot easily get rid of the machine, you know, it with you. So the fixed assets, when you do a business, you need to be very careful. You don't want to tie yourself up with a lot of stuff that you cannot really quickly convert them into cash, because it become, sometimes it's a good blessing, sometimes it's a burden, you know. Yeah, you understand what I mean? Yes. You're all waking up. 9 o'clock class. It's a little better than 8 o'clock, but it's not as good. So you should understand the fixed and the current. Yeah, you see the difference? Okay. So that's your assets. That's your first column, or the first items. And then it comes to your liability. You already understand the liability. Liability also has the current or the long term. The current means you really need to pay them back very quickly. You know, like you take a loan from the bank for 2 months, only just quickly so that the business functions. You're not taking it for 10 years. So the 10-year loan is long-term liability. You know, it's your liability. You still need to pay them back, but not in short term, you know. So it's a long term. Otherwise, if something that you need to pay them back, you need to quickly pay, that become current liability. In short term, in the short while, you need to pay them back. So what are under, let's just read this. What are the items under current liability?
Account payable, accrued expenses, deferred revenue.
Yeah, okay. So not all of the items would be applicable to your little business that's running from home. So in case something is it's kind of not making sense, then you can ignore this item, yeah, but you do need to show me, you know. Account payable means when you run a business by the end of the year, you did not pay everybody on time, right? You're just like everybody else. You don't right away pay. And people do try to pay slower than receive. That's true for every business, you understand? You want to receive as quickly as possible, but you want to pay as slow as possible so that you always have enough cash in your hand.
So that's account payable?
That's account payable. Like, you know, something you have to pay right away. You have to pay for your employee. Yeah, you have to pay for people who are working under you. That you don't want to drag. You don't want to say, I don't pay you for a whole year. That's not good. But sometimes you pay a little bit slower to people who supply goods to you, like suppliers, because you're reputable, you're in the business for a long time, you don't right away pay them. Yeah, you pay them a little bit slower. So by the end of the year, you haven't paid everything that's already supplied to you. Yeah, you get what I mean? Yeah, that's account payable that you haven't paid. The account receivable is you haven't received. Account payable is you haven't paid. Yeah. So accrued expenses means something that is expenses, but accrued together, but you have not, also you have not dealt with, become your liability. Means, well, a strange situation is you haven't paid your utility bills. Yeah, it's your expenses that you have to pay, but you haven't paid, basically. That become your liability. Anyway, liability is the money that you owned, that you need to deal with, you have to pay, you have to give them back, you haven't dealt with, basically. Yeah, that's the liability, current, urgently that need to be dealt with. Okay. And by the way, long-term liability, let's say long-term for how long? 10 years? A bank loan for 10 years? That's a long-term. Eventually you will need to pay them back, but in 10 years, so not so much in a rush, you just pay the interest. But let's say sometimes business really don't run very well. In 10 years, still cannot pay back the original loan, only manage to pay the interest rate every year. So by then you are in trouble. You are in financial trouble. Yeah. So anyway, so that's this. So we dealt with assets and liability, right? That's easy to understand. And the last column under balance sheet, 3 items: assets, liability, and owner's equity. Owner's equity is the easiest one. It's basically your money. That's owner's equity, or your shareholders' money, or your partner's money. Basically, the money originally belongs to the business, like me and Nuth, Harga, like 3 of us, we together formed a company. 5,000, 5,000, 5,000, yeah. So those 5,000 together, 3 of the 5,000 are owner's equity, belongs to 3 partners, yeah. And then we borrowed the money from Muhammad. He's not part of our company. He's just a friend that's willing to help us. So Muhammad give us $1 million. Yeah, we only have 5,000. He gave us $1 million. That $1 million is our liability. The equity is very small, the liability is very big. Maybe it's not a big blessing, you know, because you own too much. Okay, so that's basically the balance sheet. Try to do that. And income statement, maybe what I will do is I will do it. I think we should probably stop here because I think we've done enough. Yeah, we also lost a few people because these lectures often, you know, but do you have any questions for whoever is still in the class? Do you have any questions? No?
Is
Okay.
rented property a fixed property, like rented property like a fixed asset or not? Rented.
Rented, yeah. Rented is not. Rented is actually prepaid expense. Yeah, because rent, basically, rented the property is not your it's your assets. If I rented something for a whole year, it's my asset, but it doesn't belong to the fixed assets. Belongs to the current assets under prepaid expenses. Yeah. Yeah. It's good that we understand money, actually. Yeah. I strongly recommend everybody in my class, once you finish this class, you understand money, because money is very logical. Basically, which pocket the money belongs to, that's very important. Then you can understand why my business is doing well or why my business is not doing well, because in certain pocket there's too much and in certain pocket is too little, or we analyze the ratio and all of that. So you need to understand which pocket. So that is a very good question that you ask about the rental property. Is what type of asset? You know, is asset everything that you have or under the company is asset, right? Does the asset belong to you, or does the asset belong to the bank, or is it the liability, or is it the equity? It's actually equity, right? Because I paid for the rental property. But is that a fixed property, just like a building that I own? No, it's not. It's not a fixed property. Yeah, I don't own the building. I rent it. Let's say I rent it for 10 years. Then it's called the prepaid expenses. It's something you have to. It's an expense, right? Rent is an expense. It's a prepaid. I paid for 10 years. I own the right to use this building for 10 years. Prepaid expenses. Yeah, like an insurance, you know, all of that. So yes, you need to understand which pocket. So you need to think about it, you know, put all of the money in different pocket and logically understand how much is in certain pocket. Then in the future, you can analyze your own business, which is, let's say, let's not to put too much burden to analyze our own business. Let's try to analyze some business that's already established, and then let's say I'm going to buy the stock of this company, not that company, because I understand that this company is better than that company, or this industry is better than the other industry. You know, let's hope that you all have a lot of money that in the future you will invest. Yeah, you understand, and because you learned from the business class, like, you know, where do I put the money? Like, do I want to buy the stock of Apple or Microsoft? At some point, you should buy Apple. At some point, you should buy Microsoft. You know, at some point, Microsoft is undervalued because they suffered, and now they're coming back, right? Or at some point, you should buy some kind of an index of a pharmaceutical company because that's the trend. But at some point, you should sell them because they are under attack by the candidate of the President Hillary Clinton. Really attacked some of the, that's when the pharmaceutical companies stock suffered because they charge people too much and people got frustrated with them. They're making a very good profit, but you know, so that's why a lot of things, you know, even running a small business or big business or all of your life altogether is one puzzle. Altogether one puzzle. So your business class, your design class, your personal life, your relationship with your mother, your relationship with your professor. Should you be in the classroom or should you not to be in the classroom? Should you do this project? They are all together one puzzle called life puzzle. And the methodology is kind of the same actually. Yeah. So you come to school, you're not coming to school to study one thing, you're coming to school to build your whole to build the structure of learning basically. Is how do you learn, methodology. So that's one conclusion, is you're not coming to class. Let's say you have a lot of questions, the question really should come from me. Should really come from you. The solution comes from between you and your professor. That's your learning. You're not coming here to ask your professor, what should I be interested with? You already know what you're interested with. You're going to investigate on the topic that you're interested with. You coming to me to get some help, to see how we can go about and to solve the puzzle that I already have. Yeah. So let's conclude here, and I will do a very quick, short lecture on income statement, and this is basically part of your homework for this semester. Is a small business. When you come to me to do a verbal explanation, you talk about the assets. Yeah, you talk about the liability. Maybe you don't have any liability. You just need the 5,000 real, and that's from you. But if you need the 5,000 real and that's from your parents, that's actually your liability. Yeah. Okay. So let's conclude here, and I will do a very short little lecture on income statement just to conclude the financial statement, and you understand what you needed to do in order to finish the project. So so that would be by today. Yeah, by end of the day, before I go to bed, I have other lecture, and then hopefully someone will come to me on Wednesday and then start some discussion. Yeah. Okay. Have a good day, and if I don't see you, have a good week. Yes, you can.